In this video, I'd like to discuss the taxation of real estate. This is going to be focused on California. Some of these concepts can apply to other states, but some are specific to California. Looking first at real property taxes, the first thing to look at is Proposition 13, which was passed around 1978 by California voters, which says you can own a home and you pay a property taxes on that home, but the increase of property tax that you have to pay or assessed value of the home can only go up by 2% each year. There's the idea of the senior citizen dwelling benefit. Basically, if you're a senior citizen and you'd like to move homes, you'd only have and you moved homes within the same county, you could, in a house that is more expensive, you could get the same tax or assessed property tax value that you have to pay. The second home that you had in the first home, which might have been worth less, as long as it's in the same county or it's within a list, or if you're going from one of 8 counties to another one of 8 counties who does accept that benefit. There's a historic preservation property tax incentive. Historic sites have to, get basically have to pay less in property taxes. There's the welfare and institutional property tax exemptions. If you're a place which provides public welfare, or you were an institution of usually academic learning or something of that nature, you can get a property tax exemption. Property taxes become a specific lien against the home on January 1st of every year. And looking at this property tax timetable, you have that specific lien on January 1st. Then you have the county fiscal year beginning on July 1st. Then you have the first installment of property taxes due on November 1st. If they're not paid by December 10th, they become delinquent. And the second installment of property taxes are due on February 1st. And if they're not paid by April 10th, then they become delinquent. So that's basically the timetable of property taxes. There is the homeowner property tax exemption. Basically, if you own a property, you can get it's your main property, you can get $7,000. You get $7,000 off the appraised value that you have to pay your property taxes on. This is similar, or in a way, to the homeowner and renter property tax rebate, in the sense where, if you're older or you're disabled, you might not be able to pay your property taxes as much as other people would be able to. So, you can get up to $8,000 in a rebate on the property taxes. Another way with this is if you're like a senior citizen over the age of 62, you can possibly get your property taxes paid for by the state, but all those property taxes become liens against your house. Those liens against your house, basically they keep accruing, and if you pay them off, you have the state pay them off, and they can only be paid, or they're mainly only to be paid if you moved. So if you're a senior citizen over the age of 62 who lives in the same house the rest of your life, they wouldn't come pay. They wouldn't come do. You wouldn't pay them. But if you didn't move, but if you moved or once you died, then that's something that could be paid off as a lien against the home. You have the veteran exemption, about up to $5,000 per individual and $10,000 per couple, where you can get exemptions off that amount. You can get let's say for an individual who served as a veteran in an active duty time, or war scenario, or a military scenario, you could get $5,000 off your home. So $5,000 of a property exemption. So $5,000 off your assessed value that you have to actually pay property taxes on. Taxes on property, federal government, state government, county government, state government, basically governmental entities. Federal government has a lot of property in the West Coast or in California they own, so they really benefit here compared to Eastern Coast areas. And what if you don't pay your real property taxes? Well, then there's the delinquent tax sale. If you haven't paid your property tax within 1 year, you can put it on this list for the delinquent tax sale. You have 5 years then to basically pay the property taxes and any associated fees, to be able to keep your home. If that doesn't happen, it goes to a second sale. If you still aren't paying it, well, then it's going to go to a public auction. Once it's sold, you can't recover your property. After the public auction's done, and whoever wins the public auction, pays the property taxes and all associated fees which were owed for the home, they get the deed to the home. Looking at the special assessment taxes, there's the Street Improvement Act of 1911, which allows for improved streets and new sewers to be added. Through that act, there's the Melrose Community Facilities Act, which allows communities to vote for new taxes, which would help their communities. This could be streets, this could be schools, this could be anything which the community would want to pay extra taxes for. You need a vote, a majority of the community to vote for these special improvements or districts. And once you get a vote, a majority of people agree to it in the area, well, then you have it, and there would be a tax which would be paid on from each property. Well, if you don't have that way, you could have the developer before the house starts sold. Well, since it's the developer and only one person owns the property, well, the developer makes the decision, could make a decision with a vote and approve this. And with that, the developer could then, everyone who buys the home still has to pay into this special district or special improvement fund. And with that fund, they still get whatever the resources, whatever the outcome of, the use of the funds is. The developer is the only one who made the decision. There wasn't a vote of more than just the developer. Gift and estate taxes. Federal gift tax is basically the tax on individuals for giving gifts. I believe it's around $10,000. You can give a gift without taxes, or it's like a deduction of the gift taxes. It could have changed. More recently, there's the federal estate tax. Basically, when someone dies, you have to pay a tax on their estate. The state of California, there is no state gift or inheritance taxes. State and federal income taxes. So California is a state with high income tax. Well, because they have both. First, the state income tax, you have to pay a percentage of your taxes to the state. Well, then you have to pay percentage of your money, your income, in taxes to the state. But also the federal income tax, you have to pay another percentage of the money you earned in taxes to the federal government. The federal government, or the federal income tax, is a progressive income tax. So basically, if you make more money, you have to pay a higher percentage of the money you made. When there's someone who made less money, they have to pay a lower percentage of the money they made. Taxes on personal residence, you can deduct interest. You pay with your mortgages to your home, you can deduct that from your taxes. There is a limit, though, to how much you can deduct from state and local taxes. And then, if you sell a residence, and then you go buy a new one, and you sold this original residence and you made under $250,000 in profit. Well, that profit you made from selling your residence, as long as you lived in it as long as you lived in it, and you haven't sold a different residence in the last 2 years with this concept, well, then that $250,000 or whatever amount under it, you have to pay taxes on it, tax exempt. Taxes for income producing properties. You can get a reduction on your taxes, or the amount of taxes you have to pay through the depreciation of your business property. It's around 39 years, I believe, for like a business property, less for a residential property. But if you have these business properties, you can get exemptions to your taxes based on depreciation. And the sale leaseback, a company's going to want to design a building the way they want it, and then, they're going to sell the building to an investor who's, that company's going to get all their money back that they made the building for. That investor is going to get that solid rate of rent, which is going to be paid by that company which sold them the building. And that's really helpful because you can make a profit with that rent for the investor, but also, there are some payments, or there can be some exemptions for the company which owns the property. And there is the sale of real property. And there are capital assets. Basically, these are assets which are held for a long amount of time. And the federal income tax, there is tax on these capital assets. But these, like I said, the federal income tax is progressive, meaning if you make more money, you have to pay a higher percentage of your taxes. If you make less money, you have to pay a lower percentage of your taxes. And then there's the accounting for the sale of real estate, which is basically keeping everything, the exemptions you get from buying and selling, the fees you have to pay. This is really the way of calculating all the exemptions, what you can have and what you don't have to pay taxes on versus what you do have to pay taxes on. And that's that process. There's the installment sales and exchanges. The installment sales of real estate, basically paying multiple times some money for real estate, basically paying 5 times, like dividing the cost of a home 5 times and paying 5 different payments to pay off the entire home. Well, that's done, and sometimes in that way of installments because there are tax benefits. Exchanges, which are tax deferred, it's a really interesting concept, but a simple way of putting it is you basically are exchanging the property you have for a different property um, worth more money. Well, then you can get exemptions based off depreciation when you exchange the property, and you can get a lot of, you can build wealth and income, or mainly wealth from the property, getting more and more expensive properties by just exchanging them. And, well, it's a way to have to pay less income tax. That's the main reason people would do it. There's the federal and state income tax laws, the federal tax collection requirements and exemptions. Basically, foreign people who would like to buy a property, you have to withhold 10% of the purchase price for the IRS, unless the purchase is under $300,000, or it is a main residence. State tax collection requirements and exemptions, basically same thing with someone out of state when you're trying to transfer to purchase from someone out of state to the state. When they're out of state, they're in a different state from the state they're purchasing something. Well, that state tax collection requirement requires the payment. If they're out of state, they're out of state, and this is going to be their actual main residence. Well, you don't have to withhold any money, and that's around 3% for the state. Or if the sale is or the purchase price is under $100,000, well, nothing has to be withheld for the state. Looking at other taxes paid and deductions for brokers, business license taxes, there is a percentage that brokerages do have to pay in a tax for, local governments that would want some part of the money that is being produced. There are pass-through deductions. There are ways around, 20% deduction that can be made based off of variation of causes, which would go towards the business of a brokerage, which, if you use the brokerage, you got those exemptions, well, you'd have to pay less in taxes. It's off of less of a base after you've, subtract the deductions. And then if brokers, use IRA or 401k retirement plans, they can get a percentage off of whatever or they can pay less in taxes. Income can go to some tax-free investments. And that is what we were looking at with the taxation of real estate.